When we find fraud, we don't necessarily find all the fraud that's been committed. Instead, we see the fraud that gets detected. And detection may not always be as accurate throughout different business conditions or in different business situations. So Tracy has used this technique called the bivariate probit, which lets you simultaneously estimate two things. One, the probability that fraud was actually committed, but then the probability that it got detected. We applied this to firms that had their IPOs, and there we were looking at firms which subsequently, after the IPO, there was either a securities class action lawsuit against the company alleging fraud in their financial reporting, or the SEC had an enforcement action against them. And so that's our sample of detected frauds. We're looking at the whole universe of IPOs in the 90s and early 2000s and saying, okay, given that universe, given these detected frauds, what sort of factors drive that?
We estimate firms' probability of committing fraud at the IPO stage, right? And then we say, okay, how is this related to investors' beliefs about the business conditions? And we find that indeed there is a very clear hump-shaped relationship, right? So as investors' beliefs become more optimistic, we see probability of fraud, a firm committing fraud at the IPO stage goes up. But when investors are extremely positive, then naturally the probability of fraud goes down.
The reason that you get this hump-shaped relationship is if investors are really, really optimistic, there's no need to commit fraud. And so for us, the anecdotal example of this is the dot-com boom of the late 90s and early 2000s. A lot of these companies would go public and they had no revenue. Sometimes they didn't even have a business plan. They weren't committing fraud. I mean, they weren't good investments, but investors were so optimistic there was no need to cook the books. By contrast, at the same time in the telecom industry, there was a lot of fraud. People were optimistic about telecoms, but not so optimistic that they didn't want to see financial reports and the like.
Our findings suggest that investor monitoring is not going to be effective at preventing fraud when investors are actually optimistic about the industry conditions. So this is actually a good time for regulators to come in, right? Because it's almost like to some extent it's like a market failure, right? Because investors are monitoring, but their monitoring is just not going to be effective when they are optimistic, and then so there is a role for regulation, especially when the time is good.